So, good morning. So, what did we do last time? Na swali tulikuwa tumeanza na tukumaliza. I want us to finish that question, then tumalizane na hiyo mambo ya ratios. You can confirm in your notes na swali tulikuwa tumeanza. Online, which question were we meant to do last time? Just a confirmation, the last question that we are supposed to conclude on. Was it November or May 2018? Finally, there's a question I suspect to the answer. So online, you just remind me the last question we did. Someone to let me know the last question that we did. Or which question are we supposed to conclude on? Tulikuwa tunafanya ratios. You have your exercise book. So those who are online, kindly remind me the last question that we did. Someone to type for me the last question that we did, or the one that we are to do. Because I remember there's a question that we did not finish. So did we finish the question for May 2018? Question number 5, part C. May 2018, question 5, part C. So had we done the question or we were to do the question? Had we done the question or we were to do the question? Grace, you remind me, you have typed May 2018. Did we finish the question or we were to do the question? The stock holding period. Me, I suspect hiyo swali hatukuwa tumemaliza. The stock holding period. So there's something I was to clarify. That's what I wanted people to tell me. So we can go through the question afresh because it was meant to be the last question. So the question was saying that Funds Express Limited records got lost in a fire that burned down the account office. So the following information was, however, obtained from the laptop of the accountant. So the credit period allowed by the supplier was 1 month. Average debt collection period was 2 months. Then they gave us note number 3, on 31st December 2017, current assets consisted of stock, debtors, and cash only. When it comes to the note number 4, there was no bank overdraft. All purchases are made on credit. The cash were a quarter of the total sales. So required, Roman letter 1 was the cost of sales, Roman letter 2, gross profit, Roman letter 3, total sales, Roman letter 4, total purchases. Then net profit, debtors value, and creditors value. So we did up to which Roman letter on the basis of that? Because there is no stock holding period on that question. So what was the last item? Did we finish the Roman letter 1? Did we finish the Roman letter 1? Did we finish the Roman letter 1 or Roman letter 2? Are we on the Roman letter 1, Roman letter 2, or Roman letter 3? So you had to do the gross profit, but there was something that you had to clarify on the Roman letter 1. Let us start afresh the question so that people can now see what we have to do. So we start with the cost of sales. So when it comes to calculating the cost of sales, there was an issue on that. You are supposed to use the stock turnover. You are supposed to use the formula for the stock turnover. So let us start the question afresh. Let us start the question afresh on the basis of that. So to compute the cost of sales, so Roman letter 1, we should calculate the cost of sales. So Roman letter 1 of the question, we are supposed to get the cost of sales. The cost of sales. The cost of sales. So to calculate the cost of sales, we shall be using the formula of how to calculate the stock turnover. So stock turnover. So the stock turnover, it is supposed to be given by cost of goods sold, the cost of goods sold, the cost of goods sold. And you are supposed to divide by the average stock. You are supposed to divide by the average stock. So we make the cost of goods sold to be the subject. We make cost of goods sold to be the subject. Cost of goods sold to be the subject. So it will be given by the stock turnover. It will be given by the stock turnover, multiplied by the average stock, multiplied by the average stock. So we are starting the question afresh because there was an issue on that Roman letter 1. I was saying when we meet today, you have to clarify something on that. So stock turnover was given to you in the question. The stock turnover was given to you in the question. They were able to give you 10 times. The stock turnover has been given as 10 times. We multiplied by the average stock. So average stock, you simply add the opening plus the closing, then you divide by 2. Average stock, you add the 450, which is the opening stock. You add the closing stock, which is 510. So you divide by 2 to give you the average stock. So that should be your Roman letter 1. That should be our Roman letter 1. from the clarification I was meant to make. So compute that figure to give us now our cost of sales. So we calculate it to give you now the figure for the cost of sales. So that now should be able to give us the cost of sales. It will give us 4.8 million. So this should be now your Roman letter 1. That should be now your Roman letter 1. We are making some correction from what we did in the Roman letter 1 because you are having an issue on that. So we go now to the Roman letter 2. Roman letter 2, the question wanted you to calculate the gross profit. We go to the Roman letter 2. Roman letter 2, you want to get the gross profit. Roman letter 2, we compute the gross profit. So gross profit, the question gave you the gross profit margin ratio. The question had given you the gross profit margin ratio. So gross profit is given as 20%. The gross profit has been given as 20%. That is in the question. When you check in your question, the gross profit has been given as 20%. And we know that when you take the sales minus the cost of sales, that's when you get the gross profit. So if the cost of sales has been given as 4.8 and the gross profit must be 20%, so we shall simply be saying that this cost of sales must be 80%. The cost of sales must be 18% because in your trading profit and loss account, we normally take the sales minus the cost of sales to get the gross profit. So if the gross profit is 20%, the cost of sales must be 80%. So we shall be able to say that 80% is equivalent to 4.8 million. How about 20%? 20% should give us which figure? So at that point, you simply take 4.8 million multiplied by 20% divided by 80% to give us now the value for the cost of sales. So to give us the value for the gross profit, to give us now the value for the gross profit. 1.2 million. So the gross profit should give you 1.2 million. The gross profit should be 1.2 million. Then now from there, we go to the Roman letter 3. We go to the Roman letter 3. Roman letter 3, you are to calculate the total sales. The Roman letter 3, you are meant to calculate the total sales. So we go to the Roman letter 3, where we calculate what the Roman letter 3. So Roman letter 3, we calculate the sales. So Roman letter 3, the question requires you to calculate the sales. So to compute the sales, we shall still do the same because the sales minus the cost of sales, that's when you get the gross profit. So if the cost of sales is 80%, it means the cost of sales must be, so it means the sales must be 100%. Or alternatively, simply add the gross profit plus the cost of sales. You'll get the figure for the sales. Because to get the gross profit, we normally subtract the cost of sales from the sales to get the gross profit. So to get the value for the sales, we do the same. 80% is equivalent to 4.8 million. How about 100%? So sales must be 100%. So at the same point, now it will be equal to 4.8 million multiplied by 100%, also divided by 80%. Also divided by 80%. So that will give us how much? So sales is 6 million. So sales will be able to give you a value of 6 million. Sales will be able to give you a value of 6 million. So after that, now we go to the Roman letter 4. Roman letter 4, they wanted you to get the total purchases. Roman letter 4, they would like you to calculate the total purchases. Roman letter 4, they want you to calculate the total purchases. So Roman letter 4, we compute the total purchases. Total purchases. So to get the purchases, we say that cost of sales will be given by opening stock, you add purchases. You add the purchases, then you less the closing stock. You minus the closing stock. So to get the total purchases should be given by, so to get the cost of sales, so cost of sales is 4.8 million. The question had given you the opening stock. Opening stock, you are given 450,000. 450,000. We add the purchases which we are looking for. We minus the closing stock. Closing stock is 510. The closing stock is 510. So how much will be the value for the purchases? So 4.74. So online, how much will be the purchases? I would say it is 4.86. So someone has given me 4.86. They have given me 4.86. Yeah, almost all of them are said it's 4.86. So that should be your Roman letter 4. So we go to the Roman letter 5. We go to the Roman letter 5. So Roman letter 5, we calculate the net profit. Roman letter 5, we compute the net profit. Roman letter 5, we calculate the net profit. Roman letter 5, we compute the net profit. So we go to the Roman letter 5, where we come up with the net profit. So Roman letter 5, you want to see how to get the net profit. So to compute the net profit, we use the net profit margin ratio. So net profit margin ratio. It is supposed to be given by the net profit. Is supposed to be given by the net profit divided by the sales. Then we express it as a percentage. So we make the net profit to be the subject. So net profit now be equal to the sales multiplied by, or simply the net profit margin, net profit margin ratio, multiplied by the sales. So net profit margin ratio, the question had given us which percent? The net profit margin ratio. So net profit margin ratio from the question, you are given 15%. They gave you 15%. So you get 15% of the sales. You get the 15%. And the sales is equal to 6 million. The figure for the sales. Sales will part of 6 million. Yeah. So get 15% of the 6 millions to give you the net profit, to give us the value for the net profit. It will give us 900,000. Yeah, so that is now how you are to come up with the figure for the net profit. So we go to the Roman letter 6, will be the debtor's value. We go to the Roman letter 6, where we compute the debtor's value. Let us also see how to calculate the debtor's value. So we go to the Roman letter 6, where we compute the debtor's value. So to see how to get the debtor's value. So to compute the debtor's value, so I want you to check in your handout. When you check through your handout for the ratios, I want you to check on. So go to page, I want you to confirm from page 7. So when you go to page 7 of the notes, there is H, where they gave you debtors collection period. We should be using the formula for the debtors collection period for us to get the debtors value. So debtors collection period, the debtors collection period, debtors collection period, it is supposed to be given by the number of days in a year. You take number of days in a year, you multiply by average debtors, multiplied by the average debtors, multiply the average debtors. Then you are supposed to divide by the credit sales. You divide by the credit sales. So that's now what we are given down there as H. H, they were asking you, how to get the debtors collection period. So now when it comes to the question, make the average debtors to be the subject. You now make the average debtors to be the subject from that equation. So when you make the average debtors to be the subject, when you make the average debtors to be the subject, it will be given by the credit sales multiplied by debtors collection period. debtors collection period. Debtors collection period. Then we divide by number of days in a year. We divide by number of days in a year. So when you make the average debtors to be the subject, you simply take the credit sales multiplied by debtors collection period, then you divide by the number of days in a year. So when you go through the question, when you check through the question, we had already calculated the sales, but go to the note number. I would like you to go to the note number 6. Note 6, they said that cash sales were 1/4 of the total sales, which means the credit sales, it is supposed to be given by 3/4 multiplied by the sales. Remember the sales, you said it was 6 minutes. Yeah, so what should be 3/4 of 6 minutes? What should be the 3/4 of the 6 minutes? 4.5. So it will be 4.5 minutes. So now from there, we make the average debtors to be the subject. We make the average debtors to be the subject. So when we make the compute the average, so credit sales is 4.5 minutes. So debtors collection period was given to you in the question. Debtors collection period was given to you in the question. So go to the note number 2. You can see the note number 2. Note 2, they said that average debt collection period, they gave you how many months? In the note number 2, how many months are we given as the average debt collection period? Meona, in the note number 2 of the question. Online, have you seen the note number 2 of the question? In the note number 2 of the question, what are you given as the average debtors collection period? So they gave you 2 months. So you multiply by 2 months. You multiply 2 months. So that's now the data. So we divide by number of days in a year. But this one has been given in terms of the months. So how many months are there in a year? Instead of the number of the days, you use the number of the month. So divide by 12 months. Divide by 12 months in a year. You divide by 12 months in a year to give you the average debtors. So average debtors will now be the same as our debtors value, because we assume it is the one in the balance sheet, and the figure in the balance sheet is always the closing balance. When there is no opening balance, the closing balance is the same as the average. So how much will be now your average debtors to represent our debtors value? So how much is the figure for the average debtors? So 7.5 millions. I've been given online as 7.5 millions. It cannot be 7.5 millions. Others, you are getting which figure? Is it 0.75 or 7.5? When you compute, is it 0.75? Yeah, they are saying it should be 0.75 millions. So that is now our Roman letter. So we go to the Roman letter 7, where they were asking me to calculate the creditors value. We now compute the creditors value. So also to get the creditor's value, you will still go back to the handout. When you go to the handout, I've given you something on the page. When you check on page 6, on page 6, I've given you E, not even E, F. F is the accounts payable payment period. We shall be using that F to calculate what is supposed to be the creditor's value. So to compute the creditor's value, when you want to calculate the creditor's value, when you want to calculate the creditor's value, so to calculate the creditor's value, so to compute the creditor's value, to calculate the creditor's value. So creditor's value, we shall be using that formula of calculating the accounts payable payment period, or simply the creditors payment period, or simply the creditors payment period. So to get the creditors payment period, the creditors payment period, creditors payment period. So to come up with the creditors payment period, you simply take number of days in a year, number of days in a year, you multiply it by the average creditors. We multiply by the average creditors. Then we divide by the credit purchases. We divide by the credit purchases. We divide by the credit purchases. So we make average creditors to be the subject. We make average creditors be the subject. When you make the average creditors to be the subject, it will be given by the credit purchases. The credit purchases multiplied by creditors payment period. The creditors payment period. The creditors payment period. Then we divide by number of days in a year. Number of days in divide by the number of days in a year. So check over in the note number 5. Check over in the note number. So note 5, they say that all purchases are made on what? On credit. So we calculated the figure for the purchases. Go to Roman letter 4 in your notes. Roman letter 4, we calculated the purchases. How much was the figure for the purchases? 4.86. So all the purchases were on credit. They were 4.86 billion. Then creditors payment period, check in the note number 1 of the question. When you check in the note number 1 of the question under the so credit payment allowed by the supplier is 1 month. So our creditors payment period is the note number 1. They have given you 1 month. They have given you 1 month. So you are supposed to divide by the number of days in a year. But because this one is given in terms of the month, we also divide by the number of months in a year. So also divide by 12 months. 12 month in a year. So that now you will be able to calculate to get the average creditors. So that average creditors will be now your creditors value. The average creditors will now be your creditors value. Being your creditors value, it will be able to give you your creditors value. To give you creditors value. So what should be now the figure? 0.45. So it is 405,000. Yeah. So that's now how you are to deal with the question. So what I'm simply trying to let you know, you read the notes, the handout I've given you. Then in the exam, they don't simply ask you to calculate ratios. They can also give you the ratios. You look for those other missing figures. So that's now how you should go about that. So I want us to check one more last question on the same. One more last question on the same before now we move out of it. So this one, I want you to check November 2016. November 2016, question 1, part B. Also go to November 2016, question number 1, part B. November 2016, question number 1, part B. November 2016, question number 1, part B. So we go to November 2016, question number 1, part B. November 2016, question number 1, part B. November 2016, question number 1, part B. So that question 1, part B for November 2016. Sorry, question 1, part C, not part B. November 2016, question number 1, part C. The question reads that the following data was extracted from the financial statement of XYZ Limited. The information was provided from the financial statements of XYZ Limited for the year ended 30th September 2016. For the year ended 30th September 2016. So total sales is given, total liabilities is given, preference share capital, earning per share, price earning ratio. So the price earning ratio, that item in brackets, you remove that. So price earning ratio is 15. The price earning ratio is 15. Then outstanding number of the ordinary shares. Outstanding number of the ordinary shares are also given to you. So required, Roman letter 1, the book value per share. Roman letter 2, market price per share. Roman letter 3, market value to the book value ratio. Market value to the book value ratios. So we can start off with the Roman letter 1. How to compute the book value per share. How to calculate the book value per share. So to come up with the book value per share, come up with the book value per share. To come up with the book value per share. So book value per share. So book value per share. So to compute the book value per share. So book value per share, it is supposed to be given by the book value of equity. Get the book value of equity. Book value of equity divided by number of the ordinary shares. number of the ordinary shares. So when you want to get the book value per share, simply get the book value of equity. We divide by the number of the ordinary shares. Number for the ordinary shares were given. What we are lacking is the book value of equity. So to get the book value of equity, you start off with the total assets. So total assets were 7 million. Total assets are 7 million. Then we less total liabilities. Less total liabilities. Less total liabilities. So total liabilities are given 4 millions. You also less the preference share capital. You also less the preference share capital. You also minus the preference share capital. So preference share capital is 500,000. The preference share capital is 500,000. So when you minus that, what will be remaining will be the book value of equity. The book value of equity. So what will be left now be the book value of equity. So how much is the book value for equity? So it is 2.5. So 2.5 million. Will be 2. Because this is 7 minus 4, you are left with 3. Then 3 minus 0.5 should be 2.5 million. So now after that, we can get the book value per share. We can now come up with the book value per share. The book value per share. So book value per share, you simply take the 2.5 million, divide by the number of the ordinary shares. So outstanding number of ordinary shares is 400,000. Outstanding number of the ordinary shares, they gave you 400,000. It is given in the question. So divide by the 400,000. So that should give you the book value per share. To give you now the book value per share, which is supposed to be 6. Online, mnapata which figure? Book value per share should be how much? When you take 2.5 million divided by 0.4 million, it is 6.25. So now after that, we go to the Roman letter 2. We go to the Roman letter 2 of the question. So Roman letter 2 was the market price per share. Roman letter 2, they would like you to calculate the market price per share. So Roman letter 2 is the market price per share. So Roman letter 2 is the market price per share. So Roman letter 2, we calculate market price per share. So market price per share, to calculate market price per share. So to calculate the market price per share, we use the price earning ratio. We apply the price earning ratio. So price earning ratio is supposed to be equal to market price per share divided by earnings per share. So price earning ratio should be equal to market price per share divided by the earning per share. So you make market price per share to be the subject. We make market price per share to be the subject. So it will be equal to the price earning ratio. The price earning ratio multiplied by the earnings per share. So to calculate your market price per share, you simply take the price earning ratio multiplied by the earnings per share. So price earning ratio is given as 15. So price earning ratio is 15. So earning per share is 1.1. Earning per share is 1.1. So that's now what will give you the market price per share. That now should give you the market price per share. So what should be our market price per share? So we get the 16.5. So now from there, we go to the Roman letter 3. Roman letter 3, the question wanted you to get market value to the book value. Roman letter 3, market value to the book value. Market value to the book value. Market value to the book value. So we calculated the market price per share. We have also calculated the book value per share. So market price per share, you make a 16.5. So you take the 16.5. Book value per share, we calculated from letter 1. Was it 6.25? Yeah, so divide by 6.25. That's now the book value, market value per book value. Inakuja which figure? 2.65. So 2.64. So it will be 2.64 is 1 because it is a ratio. So you indicate it as 2.64 is to 1 because it is a ratio. Because it is a ratio. Because it is a ratio. So that's now the conclusion on the ratio. So I would like you to read the handout. Even in that handout, there are some questions I've already solved for you. So read them and see what you can get from there. So I want us now to have a new subtopic. We can now have a new topic. So the next item I want us to discuss will be point of indifference. Point of indifference. Now, so we can now write something about the point of indifference. So when it comes to the point of indifference, it should be simply the point of financing where the earning per share and earnings before interest and tax are meant to be the same, so that the investor is unable to make a decision on the basis of that. So we can write something brief on that element about the point of indifference. So we can note that, we can summarize that it is the point of financing. It is the point of financing. It is the point of financing where earning per share, it is the point of financing where the earning per share and earnings before interest and tax, and the earnings before interest and tax, and the earnings before interest and tax of all the available financing options, of all the available financing options, of all the available financing options are equal, of all the available financing options are equal. Therefore, the investor is unable. Therefore, the investor is unable to select a given option. Therefore, the investor is unable to select a given option. Therefore, the investor is unable to select a given option. So what we are simply presenting is that at the point of indifference, earning per share for option 1 will be equal to earning per share for option 2. At the point of indifference, earning per share for option 1 will be equal to earning per share for option 2. Also, at the point of indifference, earnings before interest and tax for option 1 will also be equal to earnings before interest and tax for option 2. So you simply summarize it in that way. So at the point of indifference, earning per share of the two options will be the same. Also, the earnings before interest and tax for the two options will also be the same. So that's now the implication of the point of indifference. That's now the implication of the point of indifference. That's now the implication of the point of indifference. Then now a new paragraph, we note that the earning per share for the various financing options, the earning per share for the various financing options, the earning per share for the various financing options can be expressed as follows. The earning per share for the various financing options can be expressed as follows. The earning per share for the various financing options can be expressed as follows. The earning per share for the various financing options can be expressed as follows. So we start with number one, all equity financed firm. All equity financed firm. So we start with number one as all equity financed firm. So when it comes to all equity financed firm, earning per share will be equal to earnings before interest and tax. Then 1 minus the tax rate, you divide by number of the ordinary shares. We divide by the number of the ordinary shares. So to compute the earning per share, when the firm is all equity financed, you simply take earnings before interest and tax, then in the brackets 1 minus the tax rate, then we divide by number of the ordinary shares. We divide by the number of the ordinary shares. Then the second one can be equity and debt financed firm. Equity and debt financed firm. So the second one will be equity and debt financed firm. So when it is equity and the debt financed, earning per share will be equal to earnings before interest and tax. We subtract interest, then 1 minus the tax rate, then you divide by number of the ordinary shares. So also now to get the earning per share, it will simply be earnings before interest and tax. You minus the interest, then you multiply by 1 minus the tax rate. Then you divide by the number of the ordinary shares. We divide by number of the ordinary shares. Then it can also be equity. It can also be equity, debt, and preference shares financed. Preference shares, equity, debt, and preference shares financed. It can also be equity, debt, and preference shares financed. So earning per share will now be equal to earnings before interest and the tax. We subtract the interest, then 1 minus the tax rate. Then we minus the preference dividends. Then you divide by number of the ordinary shares. Number of the ordinary shares like that. So when it is equity, debt, and preference shares financed, we can also express it in that manner. So we can now use a question to demonstrate that. So there's a question for November 2020. November 2020, question 5, part A. November 2020. Question number 5, part A. So we can now go through the question for November 2020. November 2020, question number 5, part A. November 2020, question number 5, part A. November 2020, question number 5, part A. November 2020. Question number 5, part A. You have seen the question? Yeah, so let us go through that question for November 2020, question number 5, part A. So the question reads that Donland Limited has a capital structure that consists of shillings 150 millions. That consists of shillings 150 millions, 15% debentures, and shillings 450 millions in the ordinary shares of shillings 20 per value, of shillings 20 per value. So the company adopts 100% payout ratio as it is dividend policy. The company adopts 100% payout ratio as it is dividend policy. The finance manager intends to raise an additional 20 millions, to finance an expansion program, and is considering two alternative financing options. So option 1, issue 12% debenture stock. Issue 12% debenture stock. Option 2, issue additional ordinary shares. At 20 shillings per value. The corporation tax rate is given as 30%. So now required, they were asking you to calculate earnings before interest and tax, and the earning per share at the point of indifference. Earnings before interest and tax, and the earning per share at the point of indifference. In the firm's earnings under financing option 1 and option 2. So that's now the question in that area. So we shall say that at the point of indifference. So we shall be saying that at the point of indifference. So we shall be able to see that at the point of indifference. So at the point of indifference, earning per share for option 1, will be equal to earning per share for option 2. So at the point of indifference, earning per share for option 1 will be the same as earning per share for option 2. So we shall analyze each option separately, then we equate them. So we start off with option 1. So under option 1, I want you to check in the first paragraph. Under option 1, I would like you to check in the first paragraph where they say that the company's capital structure, it consists of 150 million in the 15% debentures and 450 million in the ordinary shares. 450 million in the ordinary shares. So that means that company is equity and debt financed. Yeah, I hope all of us can be able to understand that at the moment, there is 150 million, 15% debentures, meaning that is debt. Then 450 million in the ordinary shares, that means equity. So that firm under option 1, it is equity and debt financed. Equity and debt financed. So option 1, it is equity and debt finance. The reason why I'm saying equity and debt is from the first paragraph. You can see the first paragraph. At the moment, there is 150 million in the debentures, meaning there is debt. There is also 450 millions in the what? In the ordinary share, which means there is equity. So even though under option 1, they are issuing what? 12% what? Debentures. But now still in their capital structure, there must be equity and what? Debt. Because of what was there in the first paragraph. So when it is equity and debt financed, earning per share of that option 1 will be equal to earnings before interest and tax. We minus interest, then 1 minus the tax. Then we divide by number of the ordinary shares. We divide by the number of the ordinary shares. So earning per share for option 1 will be equal to earnings before interest and tax. We minus interest. Then 1 minus the tax rate. Then we divide by the number of the ordinary shares. So we start by calculating interest. We start off by calculating interest. So to get interest, there is 15% debentures. We start with the current one. So currently in the first paragraph, it is 15% of the 150 millions. But I also want you to check under option 1. They have said that under option 1, they issue 12% what? Debentures to raise the new capital. In the second paragraph, they say that the finance manager intends to raise additional how much? 20 million. So the 20 million, they will raise it by issuing debentures at 12%. So you also get interest on that. So interest on that will be 12%. 12% of the 20 million. So add them together to give you the total amount for the interest. So add them together to give us the total amount for the interest. So add them together to give us the total amount for the interest. So how much will be the total amount for the interest?
The next one is state income.
Sorry? 2.49. Go confirm one. Because this is 50% of 150 million. That's a lot of money. So online, what should be the total amount for the interest? What is that total interest? 15% of 150 million plus 12% of 20 million. So 24.9 millions. It will be 24. So 24.9 millions. 24.9 million. So we also compute the number of the ordinary shares. We now also calculate the number of the ordinary shares. So number of the ordinary shares. Number of ordinary shares. Number of the ordinary shares, we do the same, whereby currently there is 450 million shares in the ordinary shares. But the bar value per share, is 20 shillings in the first paragraph. 450 million in the ordinary shares, the bar value is 20. So divide by 20 so that you get the number of the ordinary shares. So that you come up with the number of the ordinary shares. So we get 22.5 million. So now when it comes at that point, earning per share for options. So earnings before interest and tax, we don't know that figure. Earnings before interest and tax, we don't know the value. We subtract the interest, which is 24.9 million, which is 24.9 million. Then 1 minus the tax. So what are we given in the question as the corporate tax? What are we given in the question as the corporate tax? The corporate tax has been given in the question before required. It is 30%. So 30% is the same as 0.3. Then you divide by the number of the ordinary shares, which are 22.5 million, which are meant to be 22.5 million. So now we open the brackets. We now open the brackets. 1 minus 0.3 is the same as 0.7. So you multiply this by 0.7. You also multiply this by 0.7. Because this one minus 0.3. So these figures in brackets, you multiply all of them by 0.7. So this now will end up being 0.7 earnings before interest and tax. So when you take 24.9 million, multiply by 0.7. When you take 24.9 million, multiply by 0.7, it is supposed to give us which figure? $17.15. So others, I hope you are getting the same figure. When you take this figure by 0.7, are you getting 17.15 millions online? Then you divide by 22.5 million. So online, confirm for me those figures. When you multiply this by 0.7, are you getting 17.15 millions? And I say mine 17.43. They are saying it is 17.43 millions. 17.43. So that is now our for option 1. That's now meant to be for option 1. So we now also create for option 2. We now also create for option 2. That is now the equation for option 1. We should now also create the one for option 2. We should now also be able to create for option 2. We now go to option 2. So So under option 2, the farm is still equity and debt financed. That farm, it is still equity. Equity and debt financed. So the farm is still equity and debt finance. So don't look at option 2. You can see option 2. They are issuing ordinary shares. But what we do, we check what was initially there. Initially, there was 150 million in the debentures, meaning debt. Now, 450 millions, meaning equity. So even if you raise new capital, that company will still remain equity and debt financed. So when it is equity and debt financed, we know that earning per share for option 2 will be earnings before interest and tax. We subtract interest, then 1 minus the tax rate, divided by number of the ordinary shares, divided by the number of the ordinary shares. So we start with calculating interest. We start off by computing interest. We start off by calculating the interest. So we only compute interest on what is currently there. What is currently there? It was 15% of 150 million. You see currently what's there in the capital structure. So you take 15% of the 150 million. So this time around, to raise the new capital, they are issuing ordinary shares. So interest is simply 15% of the 150 million, which is supposed to be how much? So it is 22.5 million. Then we also compute the number of the ordinary shares. We now also come up with the number of the ordinary shares. So number of the ordinary shares. Currently we know it was 450 million. The bar value was 20. But under option 2, you can see under option 2, they are raising new capital by issuing additional ordinary shares at how much par value? Yeah, so the amount they wanted to raise was 20 million. But the par value per share is also 20. So you compute in that manner to come up with the number of the ordinary shares. So how many ordinary shares should we have at that level? Online, you are getting which figure? How many ordinary shares are there? Just confirm for me. So to compare, we make a decision. How many ordinary shares should we have at that level? 20. 23.5. So online, how many ordinary shares are there? So 23.5. So now after that, we can come up with the earning per share. So earning per share of option 2 will be equal to earnings before interest and tax. Then we minus interest. So interest is 22.5. Then 1 minus 0.3. Then we divide by the number of the ordinary shares, which are 23.5 million. Which are 23.5 million. So we simplify it further. We also simplify it further, whereby earning per share for option 2. So 1 minus 0.3 will be the same as 0.7. So when you open the brackets, it will be 0.7 earnings before interest and tax. You also subtract, when you take 22.5 millions, also multiply by 0.7, it should give us which here. 15.7. Then the number of the shares are 23.5. So you confirm those figures online so that we use the common values. So is that figure 15.72 millions online? Wananiambia ni 15.75. So we have it like that. So once we have presented them in that order, now we want to equate the two formulas. We want now to equate the two formulas. So at the point of indifference, earning per share of option 1 must be equal to earning per share for option 2. So the one for option 1, it is 0.7 earnings before interest and tax minus 17.43 millions divided by 22.5. Then the one for option 2 is the one that we have just created, 0.7 earnings before interest and tax. You subtract 15.75 millions. You also divide by 23.5. So I would like you to cross multiply those figures and make the earning before interest and tax to be the subject. Then you give me the value. Then you give me the value. Then you give me the value for that. So get for me the earnings before interest and the tax. Make it to be the subject. Cross multiply and make the earnings before interest and tax to be the subject.
Variables change one is in out. Variables change one is in out. It is represented by the number of we go, this is where variables change. Change was almost change 3. Now, this is where I was to look at it. No, that's I was to look at it. All the issues. Is presented by absolute fact. What do you mean by this? You see the line. Is square roots. Now this one, for every small, that's information about the data so now let's take a question. Why 0, 2, 6, 5, 7, plus 1, 5, 4, where 5 centimeters of bucket, yes, that one is very well. Now when x is 8 times y is 6 minus 7 Let us go to this one.
So we are getting to the first. So online, I've seen someone with 78.89. Others, it is which figure? Anyone else who has calculated to give me their values? Anyone else who has computed? When you cross multiply, what should be your earnings before interest and tax? I've seen 78.9. 78.9 millions. I've seen 78.9 millions. I've also seen 78.89. You also switch figure? Because you are meant to open the brackets. You are meant to open when you cross multiply. So it means it will be 3.5 millions in the brackets of 0.7. Earnings before interest and tax. You subtract 17.43 millions brackets. Then you also cross multiply that way. That is 22.5 millions, then 0.7 earnings before interest and tax. Then you minus 15.75. So you must first open the brackets. Multiply on your handicap. The same case is by this right there. Also this by that. Then you collect the like terms. You collect the like terms. You collect the like terms. So when you collect the like terms, so I've been given 3 figures which are different. So we need to confirm. So when you multiply this by this, in a which figure? When you multiply 23.5 by 0.7, sorry, 16.45. This is 16.45 millions earnings before interest and tax. How about this multiplied by that? Sorry. Sorry. 409. Also, we multiply this by that. 15.75. Earnings before interest and tax. And here, happy. When you multiply it, sorry. 3. Yeah, so when you collect the left, you see this one will come this side. It will be a minus. This one will go to the other side, it will be a positive. So 16.45 millions earnings before interest and tax. You subtract 15.75 millions earnings before interest and tax. Should be so when this one crossover becomes a positive. So, minus this minus is 16.45 minus the 15.75. It is not negative. It is 16.45 minus 15.75. And 0.7. So it is 0.7 earnings before interest and tax. Then also confirm this one. When you subtract this from that, so that I want us to get the common figure. So also subtract this from that to give me the value for that. 55.23 millions. So earnings before interest and tax, you take 55.3 right by 0.8%. So yeah, so finally should be 78.9 millions. You should be getting 78.9 millions. So that's now our earnings before interest and tax. So we can now confirm whether it is correct by calculating the earning per share for each option. So we can now get the earning per share for option 1 and also the earning per share for option 2. We can also compute the earning per share for option 1 and also the earning per share for option 2. So earning per share for option 1, earning per share for option 1 equal to 0.7 multiplied by earnings before interest and tax. You put there 78.9 millions. then you minus 17.43 millions. Then you divide by 22.5 millions. That is now for option 1. We also do the same for option 2. Option 2, it was that formula. 0.7, where there is earnings before interest and tax, you replace it with 8.9 millions. You also subtract 15.75. Then you also divide by 23.5 million. So confirm for those two, because the question wanted you to calculate the earnings before interest and tax, and also the earning per share at the point of indifference, and also the earning per share at the point of indifference. So what should be that earning per share? For the two options, they must be the same, because it is at the point of indifference, because it is at the point of indifference. So the one for option 1 is giving us which here. The one for option 1. $1.68. Also confirm for the second one and see whether it will give you the same. Also confirm for the second one to see whether it will give you the same. Yeah, so all of them are the same. So that the answer to the question was, so earnings before interest and the tax, it is 78.9 million. Then earning per share is the 1.68. So those were the answers, because the question wanted you to calculate earnings before interest and tax at the point of indifference, and also the earning per share at the point of indifference. At the point of indifference, the earning per share for the two options must be the same. Also, the earnings before interest and tax for the two options must also be the same. So that is now on how you are to deal with that question for November 2020, question number 5, part A. Now we check another question. We need to get another question in relation to that part. We should also come up with another question. So the next question, we can check the one for May 2015. May 2015. May 2015. Question number 4, part C. 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 So you check May 2015, question number 4, part C. Question 4, part C. So that question reads that Kalama Works Limited Kalama. I hope everyone have seen the question. Paper. Mine is on page 6. Online, you are able to see the question. The one for Kalama Works Limited is considering expansion of its plant capacity to meet the growing demand of the plastic products. So they are able to give you the details. They said that the company will finance the expansion program to raise the 160 millions, with either of the two plans below. So plan A, you are to finance the program with the issue of the 15% debentures. Then plan B, to issue the 10 million equity shares at a market price of 16 per share. When you got the next part, the company's income statement before the expansion is given. Then additional information, you are also given the earnings before interest and tax and their probabilities of occurrence. So required expected earning per share for each plan. They want you to calculate the earning per share for each plan. So that's now the question we shall deal with. So the time is up. When we meet at 2, because today we have another class at 2, we shall now look at that question. Then we get another question. Then we conclude on that. So we can stop there for now. When we meet at 2, we shall look at that question and another one question before we conclude now on that element of the point of indifference. So let us stop there for now.